Hello accounting analysts, viewers and subscribers, and welcome to today's video. Today we'll be talking about something that impacts everyone: how to save for retirement. Saving for retirement is one of the most important financial goals you'll have in your lifetime. It ensures financial independence and security when you're no longer earning a regular income. Today I will be talking about the basics of retirement savings, the types of retirement accounts available, and basic strategies to start building a retirement nest egg. In the future, we'll continue down the retirement path and we'll talk about more detailed strategies to save for retirement. But this is intended to be a conversation starter about retirement. Let's get into it. So why should you save for retirement? First, financial security. Retirement savings can provide a stable source of income during retirement, ensuring you can maintain your standard of living when you're no longer working and earning an income. Secondly, think about inflation. Saving for retirement helps counteract the rising cost of living, and there are investment vehicles that are geared towards offsetting rising inflation. Healthcare costs. We're all going to get old, and retirement savings can cover your medical expenses that usually increase as you get older. Longevity. People are living longer, and retirement savings support you as you age. Many people are living beyond the capacity of Social Security and pension plans, which many companies have stopped offering. So retirement savings will be important in offsetting the shortfall from Social Security and from pension plans. Let's talk a little bit now about retirement savings accounts. Now there are many types of retirement savings accounts, each with its own benefits and rules, and we will take a look at some of the most common ones. First, let's talk about employer-sponsored plans, and the first one is 401k plan. A 401k plan is a retirement savings plan offered by employers. And how it works? Employees contribute a portion of their salary before taxes are taken out. This reduces your taxable income. Many employers also match a percentage of employee contributions to the 401k plan. Contributions are made with pre-tax dollars and they grow tax-free. There is a potential for employer match, as I mentioned, and it also has high contribution limits, which is $22,500 for 2023 with a $7,500 catch-up contribution if you're 50 and older. 403b plans is another type of retirement savings account. It is similar to a 401k plan, but it's for employees of public schools and certain non-profits. In a 403b plan, contributions are made with pre-tax dollars, and some employers may offer matching contributions, similar to a 401k plan. As I mentioned, they go tax-free and they have high contribution limits, which is similar to that for a 401k plan. $22,500 with a $7,500 catch-up contribution if you're 50 or older. Next type of retirement savings account we look at is individual retirement accounts, or IRAs. Now you have two types of IRA, the traditional IRA and a Roth IRA. Let's start with the traditional IRA. A traditional IRA is a personal retirement account with tax-deductible contributions. Contributions are made with pre-tax dollars and investments grow tax-deferred. Taxes are paid when withdrawals are made during retirement. So the benefits of the IRA: tax-deductible contributions, tax-deferred growth, and contribution limits are $6,500 for 2023 with a $1,000 catch-up contribution for those who are 50 and older. Next up is the Roth IRA. Roth IRA differs from a traditional IRA in that it is funded with after-tax dollars. That means you contribute to it after you've paid your taxes. It also grows tax-free, similar to the traditional IRA, but withdrawals during retirement are tax-free. So that's the main difference between the traditional and the Roth. The Roth IRA grows tax-free and there are tax-free withdrawals. And the contribution limit is similar to that for a traditional IRA. $6,500 is a $1,000 catch-up contribution if you're 50 and older. Next, let's look at self-employed retirement plans. First one we look at is the solo 401k. A solo 401k is a retirement savings plan designed specifically for self-employed individuals or small business owners with no full-time employees other than themselves and their spouse. The key features of a solo 401k: first, you must be self-employed or a business owner with no full-time employees, except your spouse. Solo 401ks have high contribution limits. As of 2024, you can contribute up to $23,000 as an employee or $30,500 if you're 50 or older. Additionally, as the employer, you can contribute up to 25% of your compensation, with total contributions capped at $69,000 or $76,500 if you're 50 or older. So some pretty high contribution limits there for the solo 401k, as you can see. What are the advantages of the solo 401k? For one, contributions are tax deductible and investments go tax deferred until withdrawal. Roth option. Some solo 401k plans offer a Roth option, allowing for tax-free growth and withdrawals in retirement. The Roth option in the solo 401k allows for a contribution to the plan with after-tax dollars, but tax-free withdrawal when you are retired. Loan provisions. Unlike some other retirement plans, solo 401ks often allow you to borrow from your account. Investment flexibility. You generally have a wide range of investment options, including stocks, bonds, mutual funds, and sometimes even real estate and cryptocurrencies. So a wide range of investment options there for your solo 401k plan. Easy administration. Solo 401ks typically have simpler reporting requirements than traditional 401k plans, though you may need to file Form 5500 once your plan balance exceeds $250,000. Solo 401ks can be an excellent option for self-employed individuals or small business owners to maximize their retirement savings. However, they do require more setup and maintenance than simpler options like SEP IRAs, so it's important to weigh the benefits against the administrative responsibilities. Next, we will look at Simplified Employee Pension or SEP IRA. A SEP IRA is a simplified employee pension plan for self-employed individuals and small business owners. The employer contributes to employee accounts, including their own, if they are self-employed. That's how the SEP IRA works. And the benefits: there are high contribution limits, which is the lesser of 25% of compensation, or $66,000 for 2023. Contributions are tax deductible and investments go tax-free. Simple IRA, that's the next one we look at. And this Simple IRA means Savings Incentive Match Plan for employees. Both employers and employees make contributions to the plan. It's easy to set up. Employers make contributions and it goes tax deferred. Contribution limit is $15,500 for 2023 with a $3,500 catch-up contribution if you're 50 and older. Okay, so that was an introduction to some of the more popular retirement plans. We will now look at some important concepts you should learn as you plan your retirement investment strategy. So here are the key concepts in retirement planning. First, compound interest. The value of an investment increases because the earnings on the investment earn interest as well. That is compound interest. The earlier you start saving, the more you benefit from compound interest. With compound interest, time is your friend. The earlier you start, the better. Second concept is asset allocation. Diversifying investments across different asset classes, for example, stocks, bonds, real estate, to balance risk and return based on your time horizon and risk tolerance. Tax advantages. Understanding the tax benefits of different retirement accounts helps you to maximize your savings. Pre-tax contributions reduce taxable income now, but taxes will have to be paid when withdrawals are made during retirement. On the other hand, after-tax contributions mean taxes are paid now, but none will be paid when withdrawals are made in retirement. So if you want to avoid taxes when you retire, then you make after-tax contributions, knowing that down the road you won't have to pay any taxes when you withdraw those funds. Getting started with retirement savings. First thing to do is assess your current financial situation. Evaluate your income, expenses, debts, and existing savings to understand how much you can save for retirement. Next, set your retirement goals. Determine when you want to retire, your desired lifestyle, and estimated expenses to set a savings target. A common rule of thumb is that you need about 80% of your pre-retirement income when you retire. However, this can vary based on your lifestyle and your healthcare needs. And don't forget to factor in inflation. If inflation averages 2% per year, something that costs $100 today will cost about $164 in 25 years. To set a retirement savings goal, use the 4% rule as a starting point. The 4% rule states that you can withdraw 4% of your savings each year in retirement with a low risk of running out of money. So for example, if you need $40,000 per year from your savings, you would aim for a nest egg of $1 million, which is 40,000 divided by 0.04. Next, make sure you choose the right savings plan. Based on your employment status and income, select the most suitable retirement savings plans. And 4, start contributing regularly. Consistent contributions, even if small, build up over time due to compound interest. 5, review and adjust your plan. Periodically reassess your retirement plan to ensure it aligns with your goals and adjust contributions or investments as needed. Let's now look at some tips for effective retirement savings. First, start early. The sooner you start saving, the better off you will be, thanks again to the power of compound interest. And compound interest, to reiterate, is when you earn returns not just on your initial investment, but also on the accumulated interest over time. For example, if you start saving $5,000 a year at age 25, assuming a 7% annual return, you could have about $1 million by age 65. If you start at 35, you'd only have about $500,000. Quite a big difference there. Time is truly your greatest asset in saving for retirement. Second, maximize your savings. Take full advantage of any employer matching contributions to your 401k or similar plans. If your employer offers a 401k match, try to contribute at least enough to get the full match. This is essentially free money. If you're 50 and older, take advantage of catch-up contributions. And in 2024, you can contribute an extra $7,500 to your 401k and an extra $1,000 to your IRA if you're 50 and older. You should also try to increase your contributions over time. Gradually increase the percentage of your income that you save as your earnings grow. Automate your savings. Set up automatic contributions to your retirement account to ensure consistent savings. This makes saving a habit and ensures you pay yourself first. Very important to remember that. Diversify your investments. Spread your investments across various asset classes to manage risk. Don't put all your eggs in one basket. Consider your risk tolerance and time horizon. Generally, you can take more risk when you're younger and have more time to recover from market downturns. But as you near retirement, you might want to shift to more conservative investments. Monitor and rebalance your portfolio. You should regularly review your investment portfolio and make adjustments to stay on track with your retirement goals. Let's now look at some common mistakes to avoid in your retirement savings journey. The first and most obvious is not starting early enough. The sooner you start saving for retirement, the better it will be. Second, underestimating your financial needs in retirement. Remember to factor in inflation into your retirement planning. things are likely to cost you much more in retirement than they do now. Thirdly, neglecting to rebalance your portfolio. As you get closer to retirement, you might want to invest in less risky assets. As capital preservation becomes more important than growth, the closer you get to retirement. Saving for retirement is a critical part of financial planning. By understanding the available options and starting early, you can build a secure financial future. Remember, saving for retirement is a marathon, not a sprint. Start early, save consistently, and invest wisely. Review your retirement plan regularly and adjust as needed. Do not hesitate to seek professional advice and make informed decisions to maximize your retirement savings. Taking the first step today can make a significant difference in your financial well-being during retirement. And that's it for our first look at retirement planning, and we will certainly be revisiting this topic in future videos. Please show your support by liking, sharing, and subscribing to our channel. We're glad to have you on this journey with us. Until next time.